Greetings, Dr. Jeffrey Scott here, and this is my weekly market update for November 20th, 2022. I'm actually doing this on the 19th. We'll see if it gets posted tonight or tomorrow morning. I titled it, Can Holiday Cheer Break Through Resistance? It is my opinion that this is a bear market counter trend rally, that we are now getting long in the tooth. We have resistance overhead, which I'll show you, and the question will be, can the markets break through? Because typically the period of time before Thanksgiving and the holiday season going into December are strong times in the market. So holiday cheer versus Fed. This is for educational purposes only. Anything I talk about should be considered education and not investment advice. I am a doctor, not a broker. I have none of the licenses that would suggest I know anything to teach you or to sell you or trade for you. I am independent. I don't work for any software vendor or trading company, and the tools that I demonstrate are the tools that I use every day, and they're what I have paid for. Trading involves risk. You are solely responsible for any investment decisions you make. From time to time, I talk about options, and options are something that should be considered risky until you really get a great understanding of how to use them. And I refer you to the Options Industry Council or any of many other great sources for education for trading options. It's almost, well, it's got a ways to go, but it's coming up to the Wealth 365 event for January. This is probably the best one of the year. Certainly it's the highest attended around the holiday, at least it's been when I've been on. And for some reason, I get to present there, and I'm very excited to that. When I say some reason, I don't really sell a lot of things, and I don't have a website and a giant mailing list, but I still get invited to sell, and I've got some tools that are already incorporated in the program. If you go to wealth365.com / and put Dr. Jeffrey Scott, I'd really appreciate it. As I said, I don't have a mailing list, and about the only time I get, quote, credit for people signing up is when they take the link that comes from these YouTube videos. Now, I don't get paid if you sign up, but I want to be invited back, and you get invited back if you have people sign up. So I hope you can do that for me. Another thing I'd like to invite you to is I've got a live event here in Palm Beach County at Palm Beach Gardens, December 4th and 5th. It's a beautiful time of the year down here. It's before the holidays. The hotel is relatively affordable, especially considering it's in South Florida in December. You come, I feed you and water you. I'll give you some great education, and hopefully you'll leave with a big smile. Certainly will leave with a few more pounds. But basically, I've done this for years. It's always been a great event. It's usually a relatively intimate group, probably be more intimate this year than normal, I think, post-COVID. And also, a lot of people I know are not necessarily out of the market, but they're pretty quiet in the market right now. As I said, I'll feed you and water you all meals during the program. Snacks and beverages are included. We go to Capitol Grill on the night of the 4th as a team, and I'll try and invite some local folks who you might know to join us. All recorded archive material from the last live events will be sent out sometime over the Thanksgiving weekend so people can prep for it. I take recordings on my screen during the meeting and will have them up by the next day. And I share any non-proprietary indicators for TOS, TradeStation, or other tools that I have. It's limited to 15 people, and about 8 have signed up, and it's been relatively quiet. I think I explained why, but would love to have some more people, especially some of the local folks that are thinking about coming. I appreciate it if you let me know. And again, we'll really go through a lot of things that I've learned, the things that I do on these videos. I started doing these because I wanted to share with people what I learned from Ian, and it's expanded. It's $1,000 per person. You'll get your money's worth between the food and my time, but also the things I hand out and give out. All right, so hope to see you in Florida. I guess I should say next month. All right, so let me stop that. So I use a number of programs. I do most of my programs today and wealth charts. In the past, I did HGSI, and I still use HGSI. In fact, I'll look at it today a little bit as well. Wealth charts is just easy. I mean, as simple as that. You don't have to do updates or things like that. But HGSI, EdgeRater, TradeStation, Thinkorswim are my favorite trading platforms. And I'm becoming more and more interested in TradingView. It's cheap, functional. I can do it on a web, somebody else's computer. So I'm getting excited with that. And I have indicators for all of them I share at the meeting. So let's just start by looking at the market. So here are the major market indices. And if we look at 5-day change, you see mostly red. The biggest to the downside was ARK, down 9.5%. Bitcoin was down 5.9%. If we look at the major indices, which I've highlighted here in yellow, really didn't do much on the Dow or the NYSE. Spiders down 0.6, Russell down 1.7 was the worst, and the NASDAQ between minus 1.1 and 1.6. Each of these were actually flat or up a little bit on Friday. What's more interesting to me is over here. And this tells you how many days, and it's calendar days, since the market bottomed. And you could see the diamonds are up 17.7%, the NYSE 15, 13 on the spiders and the IWM, 12 on the Qs, and 10 on the NASDAQ itself. Those are big numbers. And while the Dow might be a measly 30 stocks, the NYSE is a pretty broad index. And think about what's in the NYSE, banks, energy, versus the NASDAQ, which is heavily populated by technology. So we are in the midst of a pretty big move, and I'll compare a couple of those to what we saw off previous lows as we go forward. If we look at how far we're off the highs, you can see Bitcoin just trashed. And I joked last time, and I shouldn't joke. I finally was able to prove myself right to my son, who's been yelling at me for years for not being in Bitcoin. But ARK ETF, small cap growth, down 69%, and the IBD 50 ETF is down 50. Now the FANGs are showing down 42.90, but that's a leveraged ETN, so it's probably more than the actual different symbols, but I'm not sure how much more. And if you look at where we are, the spiders are out of bear territory, I guess, minus 15. The Dow's only minus 8.7, the NYSE minus 12, and the heavily technology-laden NASDAQ is minus 30. Now, another thing that's in the NASDAQ is biotech. And look at biotech. Biotech is way off the lows, 28.2% over the last 6 months on biotech, or 5 months. So biotech is something we talk about a lot since I'm in the healthcare industry and I spend a lot of time with different biotech companies. On the sectors, you could see the only sectors up on the week were staples, utilities, and healthcare. So a defensive feel to the week as well. Now, if I look at the markets in Edge, and this is part of one of my, Sager has awesome tools, and I love his tools. He's got multiple trading systems built into his tools, and he too makes it relatively simple. If you've not heard of Sager before, he puts out a YouTube video. Superior Profit is the name of his company, Trading Profitability, I believe. It's worth taking a look because he does a great run through of the markets from a top-down perspective. And since I'm a top-down guy, I really like it. But these are sort of my dashboard, his dashboard. Now this is mine because I'm a big fan of the buckets and how extended the market is. And last week the market was extended. We talked about we were due for a pullback or sideways. We're not extended anymore, and I'll show you that a little bit when we get into some of the charts. If you look at the sectors on Friday, 82% up, 79% of the industry, 70% of the stocks. Now what's interesting, when you look back over a month, you see lots of green. But this was not a good week in the market, and you could see that you got lots of red here. With on the week 82% of the sectors, 69% of the industry, and 61% of the stocks were down. We did have a little bit of a rebound on Friday. Now, to me, this is very helpful stuff, and there's a number of other graphs and charts that are updated real time. Now, the caveat here is, and it's powered by Thomson or Metastock, Icon Metastock data. So you have to have a real-time Metastock subscription. The warehouse view gives me something I do in EdgeRater. I break up the stocks by ERG. ERG is EPS rank, relative strength rank, and group rank. Each of them are 0 to 99. You put them together, you can go up to 297. And I look for various deciles, and you could see the different deciles. It's more than 10, so it's 30 aisles, whatever that is. But you could see that pretty much everything was below 0. And some of the weaker fundamental stocks actually had a return, which is sort of bizarre. You could see on EPS rank that no earnings actually outperformed. Good earnings was not good. Relative strength, no relative strength outperformed, but stocks with relative strength were down less than the others. And if you compare this to last week, everything was up. So the markets are bouncing all over the place. This is far from an easy trending market. Now, another thing I do in EdgeRater is the Hindenburg report. And those who've been following me for any length of time know how big of a fan I am of the Hindi, and because it saves my bacon. And just to give you an example of that, if we go back to the end of the year, this red line at the very top, and I'll look at regular charts in a minute, was a Hindenburg omen. And when it starts firing 3, 4, 5 times in a row, it tells me to get out of the market or to be very careful in the market. And it called this high, it's called every major market correction since the Great Depression was preceded by the Hindenburg omen signal. Now the problem is a lot of them are spurious. I look for a confirmed one, which is at least 2 in 30 days. And when I see multiple over a short period of time, I pay attention. Now on the NASDAQ, we haven't had a Hindenburg since we rolled over. This is only going back to February. But I like to track this because I can look at new lows versus new highs. And we can see on the NASDAQ, you still see lots of red. You only see some new highs pulling through one day from last week. Now, when the market's good, you'll see 8, 10, 12% new highs. And when the market's bad, these are not big numbers. You can see 15% and higher. Here's 24, 25 on the new lows. This is the weekly bongo. That's my long-term timing signal, which is actually green here, which is good. And I see none of my impulse indicators. Now, what I thought was interesting, and it's a contrast. If we look at the scores here, these tell me weekly percent off the 52-week low. And we actually got off the June low in 57 trading days, 23.5% up. Then we reset, and you can see these are the days of the lows. The October 13th lows, of which we are up now 36 days, we're up 10%. So the NASDAQ has not matched its prior move off the lows. But if I look at the NYSE, we're actually seeing green here, not seeing red. The interesting thing on the NYSE at 15.3 rather this week, down a tad, we've exceeded the biggest bear market rally that we've seen. We're just down a teeny bit over the prior week. So the NYSE broad-based and not a technology-laden or as much technology-laden index is actually outperforming. Now, in the Q-Edge tool, I have my buckets in real time. That is awesome because you'll find during the market what I'm going to show you in a moment in end of day. During the day, it happens. And when it happens, it gives me short-term signals in the market. Down here on the left is what I call left shift. And you notice the big red lines are to the left. And when it's below 0, that tells me here 45% of the stocks in the S&P 1500 are below their lower Bollinger Band. Well, what do you think happens when that much of the market is trading below the Bollinger Band? It reverts to the mean. When I see that, I know the market's likely going higher. This is a right shift. 40% of the stocks, this is going back to October 28th, were above their Bollinger Band. Here's where we were last week, 30%. And that's why I said on my video a week ago that I expected the market to go sideways or pull back. And we've come off that right shift. We're still tilted to the right, but we're no longer extended where we have to expect a pause or a pullback. Now, this works really great except in really bad markets. And I think it's still a great signal for me to use, but when it doesn't work, I know that we have problems. And I call this my oops sheet. But you could see October 3rd of '08, 6th, 7th, 8th, 9th, and 10th. And we got up to over 70% of the stocks on the 7th and the 9th. So it took several days to bounce in this recession driven, horrible bear market. Not ours today. Energy, the only winner on energy over the last week was natural gas. I refer to this as the most manipulated market on the planet, and I say that because natural gas is whipsawed because of Ukraine and Russia. There was significant weakness in oil, down nearly 10% on crude. Brent was down 8.49. Gasoline was down 7.28. If we look at energy and we look at the weekly on energy, mix was, on metals rather, gold and silver came off their recent highs. Copper was down 8.3. Steel and iron ore bounced. Titanium, for reasons I have no idea, was a big loser, but it looks like it's been a big loser on the month. Baltic Dry Index really not doing anything. We'll see if it sets a higher low here. This is tied to things like Star Bulk shipping, Zim, and it's sort of the spot price on dry goods that they might be shipping. Interest rates, this is a driver of the recent improvement in the market, and you could see that the 10-year and the 30-year have come down. Up here you see the 10 minus 2 and how inverted we are. And although some people like the 10 minus 3, and the 10 minus 3 did give a more impressive inversion in the 2020 bear, I will call that out. But every time we've inverted on the 10-2, it's followed in gray bars by a recession. And you know what? What do you think we've got coming next year? I think we've got a recession. And we're in a bear market, and bear markets don't like recessions because you get an earnings drop. So you get earnings compression on the multiple and lower earnings, which can lead to 30-40% further drop in the market. Yes, I do think that's happening next year. I hope I'm wrong. I hope rates correct quickly, the Fed pivots right away, and interest rates come down. I'm concerned about that. And then this is credit tightness. And although we're kind of going sideways for a couple of months here, the fact that it's elevated and it's elevated to the level that we saw in 2019 should make us worried, because here's what happened in 2019. The market sold off. The market sold off. This was elevated in 2018 going into 2019. So I'm concerned about this market. I'm concerned that we got a recession coming. And even when I get these bear market rallies, I'm still not going all in. Overbought, oversold. Stocks above the 200 sort of stalled on the week. Stocks above the 40 stalled a little bit as well. Just kind of a week that didn't do much. Now, another one of my short-term overbought, oversold indicators that I love is this 13-week new high, new low indicator. And these are some TC2000 charts, by the way. And if you come to the meeting and you ask me nicely, I've got a lot of stuff in TC2000 and eSignal as well, of the stuff that I use that I'm happy to share. But I don't share routinely. I share to people that come to the meetings. And you could see here the T2121 came off what was approaching, get nervous about a pullback, so we've eased some of that extension. Economic news, well, we got Wednesday's an interesting day. That's a lot of stuff for the day before a holiday. And oh, by the way, here's your Thanksgiving present from Chairman Powell. The minutes come out at 2 o'clock on Wednesday. Now that meeting, it was the meeting that we had that head fake, the market traded up, and then he opened his mouth and said there's nothing bullish in the report, and the market sold off. We've had multiple Fed heads trying to talk down the market since then. Probably going to be a negative report, but maybe it's already baked in. Earnings, short week, not much in earnings. Dick's will be interesting. Foot Locker had great earnings. Crocs is looking good, and there's a lot of footwear in Dick's Sporting Goods. Now, I think Burlington came out this past week. Um, Although Ross Stores came out this past week, and they really had a nice response to their earnings. Now, last week was quiet in the expected move department. Just remember what this is. It's a straddle. You're buying a call, buying a put at the money. The gray line is the closing price of the prior week. The green is where you have to go above to make money on that trade. Red is where you have to go below, at least close below, to make money on that trade as well. And you can see on the S&P futures, the NASDAQ futures, the Dow futures, the Russell futures, we close within the lines, so the money makers made money. The VIX futures, traded down, but it did not go outside, nor did it on the dollar. Probably one of the quietest weeks I've seen in this in quite some time. My thoughts on the market: we firmed a bit Friday, but we still traded down despite a softer than expected PPI. Look at the CPI response, off to the races, 500 point plus day. PPI, we went up and came back down. As I showed you, we've moved up higher over the last 36 calendar days. The diamond's up 17% from the lows. We've had Fed heads talking the market down. Now, if you want to be bullish, strong seasonality, CPI, PPI in the midterms, and yes, I do know how to spell, but I didn't spell it right there, are behind us. So if this market's going to rally, there could be tailwinds to support. From a bearish perspective, I think we're getting at resistance on the indices. We've had a nice run. I still think we're just a counter trend rally, which will fail. And so I do think we can go higher here short term. We might stall first, but I'm really concerned about next year. So if I go all in on my cash because I think we're rallying, I'm going to have a really short leash, and I don't think I'm going all in. I'm playing with small positions here because I'm worried of where we're going. Now, this is something I stole off Twitter. Stole. I copied. And I'm sorry for the person who put it up because I cut your name out. I didn't do it on purpose. But this is a shot from Bloomberg. And it's just important because look at the size of bear market rallies in the 2008-9, 24.22, 18.47. This rally is nothing different than those. 20.8, 20.6, 21.4, 19. So yes, this has been a great rally off the bottom, but really, is it really that much different? And then just to remind you, Stocks and Docs is my day-to-day channel where I put things out Monday, Tuesday, Wednesday, and Thursday before the market, and then again over the weekend. The YouTube videos I put out once a week, and they're all free, and I do my ranting and raving there as well. Now, I mentioned the Hindenburg Omen, and I'm just going to make a couple comments about it. And am I missing the top? So if you notice these red lines up here, this red area, this is 2006 top. A bunch of Hindens fired, the market rolled over. Here's a 2007 top, bunch of Hindis fired, the market rolled over. Here's the 2015 top, bunch of Hindis, the market rolled over. Here is the 2018 top, bunch of Hindis, market rolled over. Here's the second top in 2018. This was nasty because it occurred. Remember, this is the day after Christmas reversal. A big sell-off occurring during the holidays. And then here is the 2020. Yeah, we had the Hindis even before we had the COVID. The Hindenburgs knew that the COVID was coming. So I love that signal. Those that come to my meeting, I've got it for you in TradeStation, and we'll go over this and Thinkorswim rather, and we'll go over it in great detail. One of my favorite, maybe voodoo, maybe not voodoo, but it's one of my favorite indicators. All right, let's close that. All right, so this is HGSI. I want to spend a few minutes in here just because there's some things in here that I can do that I can't do in other programs. Now, very quickly, here is the spiders on the daily chart. Here's the weekly chart. When you look at that weekly chart, do you get the sense that we can't go any lower? Maybe I get the sense that we got resistance right up here. We got the resistance at the 200. Can we go up more? Sure, we can go up more. All right, but I'm concerned that we're getting at a point that we've got resistance, and I don't think this is a resumption of the bull and a rally to new highs. We look at the diamonds, which have been the big leaders, and look how the diamonds have broken out. Now, the diamonds look great here, but you can see they actually took out this resistance line. And so that's interesting, and that's different, and something that I'm going to pay attention to. But right now they're going sideways. I'd like to see these things get up to the April level, and to get up there we still got over 1,600 points to go. If I look at the Russell, and we're going to look at these in wealth charts too. Look at the Russell clearly failing, because there's some things I built into Russell, or I have in the Russell in the wealth charts that I want to look at, and then the NASDAQ. This here is the 100-day moving average. Interesting, it failed it. That didn't even get to the 200. I don't see anything that looks great there. We'll look at it in wealth charts in a moment. What I really like about this program is how it handles the industry groups. So I've highlighted industries. I hit the warehouse, and all those industry groups are up here. And I like to rank them by the 2-day force. When I do that, I got 48 that are bullish. If I look at 2-day down, I've got only 7. So that tells me that there's strength in the market. Even though I'm worried about the markets and resistance, I still got some underlying strength. If I go back to the 2-day up, and what I like about this program is I ranked them by raw combo. If I right-click on communications and change to index group, the top stocks in that industry come up. So I can go through them very quickly. Apple's got to get above the 200. Cisco is on my buy watch list. And why is it on my buy watch list? This is my squeeze, my mobile breakout. This is a John Person buy signal taking out the 200-day moving average. This is what's called the pocket pivot, and this is a kahuna. Cisco's one of the better looking charts out there. It's taken out its resistance above. Still got a lot of overhead supply, but that's one I liked. And I could just go through the top stocks. Clearfield, I don't know much about it. If I wanted to, I'd say that's a good pattern. It's a Bible gap up, a kahuna, a mobile breakout. I just don't know that company. That doesn't mean it's not a great company. And I can go down the list. Next is specialty apparel. And I just wanted to look at Ross Stores because there's a story here about Ross. Could you have bought that stock on Friday? I say no. Why? Because that's a red candle. That means it opened up here and it traded down the rest of the day. And you'd have to have been in on Thursday or Wednesday to make sense. But I would have got into it here. And, you know, this is what I look for. There's my mobile breakout. There is the squeeze. There's a kahuna, the squeeze, the mobile breakout, and the break above the 200-day, and this here was my chandelier stop I took out. So actually this was a good trade, but you had to get in. You couldn't buy it on Friday. And we've been talking about the apparel retail for some time. Bed and Body Works still has to get above the 200. Foot Locker's another one that had a big move. But the same thing. Do you buy this thing? Well, at its open, it was $38.25. It closed at $34, $4 or 10% off the high, and it was still up 8.73%. So you got to be careful on the gap up. So I don't really like chasing these unless they close near the high. I want to find stocks that looked like Ross Stores when it was breaking through. The next one down is Gap, and you could see Gap gave me the signal over here. I've got a mobile breakout from a squeeze. I've got the John Person indicator, a pocket pivot, and a kahuna. And I did buy some Gap over here. And here's Burlington Stores, which has earnings. So the other thing I like about this, if I open this window, I can actually see the earnings dates and a view of the earnings. So what I really like about HGSI is how easy that is to go from industry to sector to or industry group to stock to chart and then go through the stepwise those within that industry. So enough confusing you about multiple programs, but if you come to my meeting, we're going to spend a lot of time in both of these programs, and hopefully when you'll leave, you're going to have a really good weekend and daily routine that can help you make money in the markets. Um, it's education, it's a little bit of hand holding when we're live, and it's giving you the tools to be your own guru. And the thing about be your own guru, that's something that I called my meetings and called them for years. It's something that Ian Woodward told me. He says, I'm not a guru and I'm not here to be your guru. I'm here to teach you how to become your own guru. And I hope that I'm able to impart some of the wisdom that I've gotten where I've learned about these tools and these signals to help you excel in your trading. That's why I do these videos and that's why I do my live meetings. So I've now gone into wealth charts and we're going to start my routine that I do on the weekend. XLV, I'm starting with only ETFs and looking at hot stocks, or in this case, hot ETFs. So there's nothing in the 8s or 7s. Healthcare and 686 had a flame. That's nice to see. Insurance at 650. Pharma's at 400. And SQQQ had a flame. We don't want to see that going up because that goes up when the market is going up. And these are looking for bullish movement. All right. The indices, now why would I need the indices and wealth charts if I have HGSI? Well, because in wealth charts I can look at intraday charts and I could see that on Thursday we had a major gap up and the market sold off. And then, actually make sure I got my days right. Yep. This is on Friday we had a gap up. The market sold off, and then the middle of the day, the market started to recover. Same on Thursday, the market sold off in the morning. Hold on, I was right in the beginning. My bad. Here's Thursday. Aha. Let me do this. Boom. Leave page. Let's see if I can bring that up. It's been on all day. I want to just go back and make sure everything has appropriately updated. Okay, those are the same. And now let's look at the 5-minute chart. That's Thursday. And Friday is that's the end of Thursday, a gap up into Friday, the sell-off intraday, like I said, and then a rally into the close. Big volume bar on the close, but we typically see that in the opening bar and the closing bar. The daily charts, what I have here that's different is I got 3 time frames of the bond growth. The daily and weekly are green. Here's that 200 that I'm concerned about. There's probably a trend line. Let's just draw the trend line here. Trend line. There's probably a line from up here through that highs. That's right here as well. So I think this is very likely going to be resistance in here. And that's kind of why I'm concerned. And we could see the sell-off that we saw here after the August run-up. So are we heading for resistance and a return? Possibly. What is that yellow line? That yellow line goes back all the way to the June lows, which we broke in October. What is the white line? The white line is the high before the 2020 bear. Here is the Qs. The Qs are above the 50, as is the spiders, which is good. The Qs are also having to get above that 200, which they're not. And let's just drop that same trend line there on the Qs. And I've never considered myself the king of trend lines. I like looking at them. I just don't like drawing them. So somewhere in there, so there's still another 5% maybe you could run up, but to me you've got resistance overhead here. The diamonds have broken above their 200s. That is awesome. Let's just throw the same trend line up here and see where they are compared to its trend line. And you know, trend lines are kind of in the beauty of the beholder, and there's lots of trend lines that could be drawn, but no shocker, we're sitting right on trend line resistance on the diamonds. I'm sure we're the same thing on the Russell, which is struggling at the 200. Now, if the markets are going to roll over, we might expect that the VIX was going to move up. The VIX is soft. And I think as long as the dollar here remains weak, we have a chance of the market going higher. But I think there's a couple things that are driving the market higher. And let me go back and add my broker data, which I lost when I did that reset, which I may not have needed to do. Okay, and we look at commodities. The other thing that's driving the market is that the 10 years have come up way off of its highs. So down to here, and although it was up a little bit the last day, it's still way off the highs. It's below the 50. Gold and silver have had nice runs, but if the Fed keeps tightening, gold for sure is going to get lower. Oil has sort of been, well, a lot of reasons for what oil does, but it was stocked between the 50 and the 200, actually broke below on big volume. Suggests to me oil might be going lower. And then if I look at natural gas, it actually was stable up on the week, but again, that's probably driven by geopolitics. My weekly market timing system requires two things. The weekly price has to close above this white line, which is the 30-week WMA, and the weekly bongo has to be green. So on all the major index or sector ETFs, or excuse me, market ETFs, the weekly bongo is green, and we are above on the spiders, we are above on the Russell, we are way above on the diamonds, but we haven't got above on the Q. So just like last week, if I had to go long, the place that's probably the weakest right now is the Qs, but I keep watching that for it to change. Now I thought we get a further pullback here, and we still may. Time is still early. If I look at the market theme, I like to look at this to get a sense of, are we looking at, is the market favoring large caps? This is a ratio of IWB large cap to IWM small caps, or small caps. And we're heading up towards the upper right-hand corner, which is large caps. So if I look at the hourly, you could see we've come off the small cap strength. And if I look here at spider growth versus spider value, we've been down in value for some time. So we are looking at large cap value stocks here. And so, I mean, that is defensive if I ever heard it. Now, to figure out intraday what's really working right now, I like to look at these ratio charts that compare each of the S&P 500 sectors versus the spiders. And what I'm looking for are two things. I'm looking for longer term strength. So what's up here in this upper right hand corner? Industrials and financials and energy have been there, as have healthcare, but they've all weakened a little bit. And then I look for these blue lines that tell me short term we're moving. We had some strength in technology, staples, utilities. Now, sometimes it's very obvious where I want to be going. Sometimes they're all doing the same. And remember, this is relative to the spider. So if the spider's up, they could all be outperforming or underperforming. It's relative to the spiders. If I go into my bull scanners, because even though over a longer period of time frame I'm probably bearish, we haven't reversed yet. And let's just go into the heat map and we'll start there. And, the S&P 500 was up a bit on Friday, probably the strength driven by Apple. Apple's only up a few pennies. I think the most remarkable thing here is how Tesla, for quite some time, had really been driving this market. And, you know, I talk mostly about the long side, and there's a reason for that. Not everybody shorts. Um, Not everybody has their money in an account that you can short. But the signals are very similar to long signals. So here was the time to short Tesla, in my opinion. Why? Because we had broken below the 50, tried to get back above and failed, and at the same time we had a high volume breakdown with momentum coming out of a squeeze, a PSAR reversal. All three bongos went red and we broke below our averages on relative strength and OBV. I look for that signal for shorting, and I look for the opposite when it comes to buy. Tesla, which led the market, I listened to a very smart person earlier today, and he thinks it's going down to 100. Why not? It's still overpriced where it's at today. Sector scanner is the tool in wealth charts that lets you break out the sectors. We could see one day industrials, utilities, financials. Here's your staples, your discretionary and staples. Here's weekly performance. Another thing you can rank by is the algorithmic score. Sometimes that's better because these sectors, at my request, by the way, are so big, maybe too big, that there's often outliers that move that number, but it doesn't really affect the algo. Now, what you can do from a top line perspective here is just rank by algo, for example, and take the ones that are at the top, and then look at the weekly and make sure you got the ones that are at the top. Include this. And then you could hit compare, and that brings up all the industry groups. And maybe you just look at the algo again, and you take the top bunch of the algos. Whoops. Hate when I do that. Let me go back. Let me try that again. Compare. Rank by algo. Click in this box. Hold my shift key down. Let's click down here. That highlights those. Let's just look at the weekly algo and see if I missed anything. Let's just get the ones I'm missing on the weekly. That's enough. Now I hit compare. Let's rank by algo. And this is bringing the leading stocks in the market coming up. Let's just go down to 500. And now I've built a list of the leading stocks in the top industry groups and the top sectors. Default watch list, make sure it's my weekend review. Hit apply. It's going to tell me up there it's updating my default watch list. And now I'm going to add these to my watch list. Awesome. So now I've built a watch list that has a number of stocks in it from my scans before, and then the top stocks and the top industry groups. So let's just kill all this stuff. Now, Wealth Scanner lets me look at a list of stocks. In this case, I'm looking at major market ETFs to see what's leading. And here it is. Staples is up there at the top. Dividends, pharma, healthcare. Interestingly, Euro stocks are up. But notice nothing's got 8 in it. So some of the bullish move has come off. Now I can go to CAT Scanner, and I'm going to look for stocks that have a little bit longer or a weekly bongo green, so I know they've been in at least for the last several weeks, in an uptrend. I want to combine them with a daily trend that in the last 2 weeks has switched from bearish to bullish, so they're not too extended. So let's start setting that up here. 5 and 500,000, one bullish dot, no bearish dots. I want to have switched in the last 2 weeks, so we'll put 10 trading days. And then I want to go down here and make sure my daily bongo today is bullish, my weekly bongo is bullish. Hit apply, and then this is looking at all those weekend review stocks, and I can start to now go through this list, ranked by the number of bullish signals they have, and see if I can't find something that I like. AKTR is a healthcare stock, and this is one that, let's get it into the daily. So let me just explain what's on my charts for you, something I probably should do more often. So on every platform I use the same moving averages. And those moving averages in red is a 200 simple, in green is a 17-day simple, in yellow is a 50-day simple. The circle is a Rob Hoffman indicator that is free in Wealth Charts to annual subscribers, called the Wealth Signal. The triangle is what I call my EMS, my early movement signal, which is a signal that totally independent of the rest of my signals, that's been a really good buy-sell signal for me over the years, especially if we're beginning a new trend. This obviously is volume. These are my dots. There's no gap dot. There's a gap dot if it was there. Volume, breakout, momentum. This is my squeeze indicator, PSARs, red candle highs, green candle lows, 3 time frames of bongo, my high jump, relative strength versus the spider and its moving average, on balance volume versus 10 period EMA. So don't know much about this. It's an expensive stock. So by definition, it's over $5, over 500,000 shares. Its weekly bongo has been green now going back to October 17th, and you can see it's in a nice weekly uptrend. It has at least one green dot. It's got volume, breakout, momentum. Both bongos are green, but you can see the daily bongo in the last 2 weeks had reversed, and its relative strength and OBV are going higher. That's the pattern I like to see. This is broken out of a relatively flat band. The problem with this stock, I don't know if I see any problems with this stock. There's not much overhead supply, so I would do my research, find out why it gapped up. That doesn't look bad at all. Buckle. There's a lot of teen-related retail that have been moving. This one had an EMS signal come in Friday, took out, it's above its 1750 and 200, which is exactly how I like my moving averages to fan. Relative strength and OBV are moving up. Volume, breakout, momentum from a squeeze, both bongos, relative strength and OBV. Don't know much about this. I don't like the fact that it closed in the middle of the day of its pattern, or at the bottom of its pattern rather, but it still had a big move up and might be worth watching. Foot Locker looks a lot like the which is what I showed you before, Ross Stores. Big gap up, closed near where it opened, but look at this nice pattern. It's sort of a cup handle breakout, massive volume, 3 dots out of a squeeze, relative strength OBV. Foot Locker looks interesting. Here's, I think it's a processing company in Central America or South America. This thing's been dead for a long time. You could see it goes back to the days when it was nearly $100 going back into 2021. It took a dive and it's been pretty much doing nothing. So there's something happened here. The relative strength is better than the spider. It's coming out of a squeeze on the weekly. And you had a breakout with volume, 4 dots, gap, volume, breakout momentum, relative strength and OBV starting to move. Probably a little riskier because this is such a beaten up stock. But you go down the list, you can see one after another of these very similar patterns. Deckers is coming up with earnings. Kind of looks like the earnings came out, but I'd go and check that. But according to the earningswhispers.com, it's this week. But this thing is setting up. Maybe it's up on Foot Lockers. EMS, big volume momentum, relative strength and OBV moving up. I don't usually like to play earnings before the earnings come out unless I have a big profit in it. But sometimes I'll take a starter position in options. Um, and but risky because I got to be prepared that I'm going to lose the whole thing. So that's how I look at the market. I take into the top down by mixing it in to my list by putting the top stocks in it. I show you how I do the top down in HGSI. Now, staples are strong, or any stocks in staples looking good right now. Let's just see. So I can pull up the sector. CAG, ConAgra Brands. EMS signal. It closed off the open, but really it's more of a hammer. Breakout momentum volume, relative strength turning up. All right, that's interesting. I might look more at that. I'm a cancer doctor, so even though VGR, which is I think Vector Group, has an interesting looking chart as well, stalled under that 200 and broke above it. I can't buy it. It's tobacco, but that doesn't mean you can't. Pepsi. I mean, if this market pulls back, one of the defensive ways of playing it is staples. Another thing that's been leading for quite some time is biotech, so I've built a list of biotech stocks as well. ISEE, I think they may have had an FDA approval this week. And, people think you got to buy these things before they get approved. I'm not the biggest agreeer of that because all the risk is before they get approved. So here's nice volume, big move on Friday, volume breakout momentum, rail strength and OBV look interesting. Now, why did I say you don't have to buy before the approval? Let's look at Axisome. I was sitting in this stock. I knew it had some news, that it had earnings, a FDA stuff coming out. And the reason I was in the stock watching it pull back was because I'd read some of the reports, and the reports were about they're in label planning, they have addressed the issues the FDA had, and everything sounded to me like they would get approved, and you could see what happened on the approval date. But they got approved. The stock ran up from 20, had a nice move from 25 to say 36. But the stock has doubled since then. It's pulled back of late, but you didn't have to be in the risky. You could have bought it after approval. How about CTIC? It's a cheap stock. All right. You got to go back to when it got approved. It got approved, I believe, in February. So that is March. All right. So this is when it got approved. The stock was languishing. In fact, the day before it got approved, the stock actually dropped. The next day it got approved, it was $2.73. The stock ran all the way up here to $5.50. Is it done? Nope, it's not done. Now it's run up to over $7.77, and now it's languishing, but I think it's languishing, getting ready to run again. So let's go back to ISEE. Is it too late to buy? I don't think so. Do your homework. These are not recommendations to buy or sell. This is how I identify stocks that look interesting. Now, my system works with shorts as well. So I can go to my bear scanner, pull up my weekend shorts, and see if anything really looks interesting here. Now, this one's going to be different. I like them more expensive, 25 and 500. I like them to have some options available, at least a bearish dot. I want them to reverse from a bullish setting to a bearish setting on the daily within 5 days. Bearish bongo daily, bearish bongo weekly. And I'm running it against my bearish list of the week, and Live Nation. There's all kinds of issues related to um, Taylor Swift. And, I like this. Why? Because it's failed here. You got the 200 above the 50, above the 17, a big volume sell off. You've got momentum volume and a breakdown. Look at relative strength and OBV. You've had several days to get into this. Still high enough for me to consider shorting. If I did short, that's your business, not mine. And I could look at all stocks and see what comes up to this list. Now, the problem with the way I look at things, and it's only a problem for over the weekend, I look at it every day. They don't stay with 3 or 4 dots for a long time before they make their move. So every day I find new ones. New Relic. Let's see what this one looks like. Yeah, look at this. This is a stock that's been going sideways, has failed at the 200, the 50, and the 17. It's got an EMS and a wealth signal, had big volume, 3 dots, PSR reversal, and look at the relative strength and OBV. So I use the same tools for finding longs and finding shorts. Now I know some people like to see the list that I'm going to be watching for my buys and my shorts, so I'll spend a couple seconds with that because I'm still less than an hour. Again, these are not a buy list or a shorting list, but what this is a list of stocks that I'm going to monitor during the day. So Ambarilla was one that looked very interesting, up on earnings, actually on inking a deal in the automotive technology business. Look at the volume came in. A clearing of that 200-day moving average would get me very interested. So I'm going to be watching Ambarilla. Look at relative strength and OBV. Oh yeah, I didn't have to wait here had I been paying attention to this stock. Look at the 3 dots on this day with OBV and relative strength moving up in an EMS signal. Sometimes I have this problem. I'm sure nobody else does, where I get my biases get worked in, and I had a bias against this because I thought about GoPro in the early days when this was a $200 stock. Well, you know what? They've remade themselves. Ambarilla looks good. One that I'm already in, I don't think you can buy it here, but just showing you the strength of GenMab, and I did talk about this one earlier this year on several occasions. I think I talked about it in the beginning of June when I was at ASCO, and that would have been back here. GenMab makes a drug that's marketed by J&J, which is a blockbuster in a type of cancer called multiple myeloma, and they've just been benefiting from their massive royalties on that. So these are just some of the things I looked at. Merck is probably my favorite of the big pharma. Is it too expensive? Yeah, it's probably too expensive here, but it wasn't here. Okay? It wasn't here when it broke above the 50. My signals work. They get you in, they draw your attention. You have to make your own decision what you're going to buy and when you're going to buy it. And probably the best time to buy it was back here. But it's running again. And I remember this day because I looked at it and said, man, this is expensive. And here was another time that I was getting interested in coming out of the squeeze here. You could see we actually drew about it, thinking that it was a cup and handle setting up. So a lot of interesting looking stocks to the long side. Look at United Healthcare. I like buying this thing in pullbacks. You want to see what a long-term winner looks like? Let's just bring out a monthly chart on United Healthcare. Yeah. You think that's a long-term winner? I bet somebody thought it was expensive on every one of these bars. It's expensive now. But United Healthcare pull back to the 200 and it's moving. How about the new name for Anthem is Elevance, ELV. Look at this over the long term. Let's put a monthly on this puppy. Oops, wrong one to put the monthly on. Go back, change that to daily. Put my monthly over here. And look at this move up since 2020. I like to buy these things when they pull back, and when it's sitting on the 200-day moving average, it's on my watch list. Now I'm just going to finish by pulling this back and showing you, I mentioned Sagar, I mentioned the Q tools. What I end up doing is I'll take my watch list and I will go into TradeStation and I'm going to stick these things into some various radar screens. This is like the most awesome radar screen. This is Sagar's, I'll just go my buy watch here. Sagar has a number of different setups. I can put my stocks into this watch list and I can watch them for his various setups. And when he has his setups, I wonder where he got this from, Sagar. I love it. How many of the bullish ones or bearish ones are firing? So I stick them in here. I watch for the signals to come in, and that will drive me to looking at stocks either end of day or if I can glance during the day. It's been an hour. I went through a lot of things. Come join me in 2 weeks, I guess. Is it 2 weeks? 16 days. 2.5 weeks. I'll be making the PowerPoints over Thanksgiving. It will be educational. It will be a nice networking opportunity to see some friends. And I hope I can see you in South Florida. Like I said, it's a light turnout. Frankly, disappointing. Hopefully some of the locals will want to support me and will come anyway. So talk to you all soon and have an awesome, awesome, awesome Turkey Day. Thanks. Have a good one. Bye.